Reviewing your portfolio allows you to check the performance of your investments and see if there's a need to change anything. I recommend you do this once a year, and this video will show you things to consider while you're going through this process. What's up? My name's Maggie Gomez, and I drop videos every Friday teaching beginners how to invest and feel confident in their financial life. I'm a certified financial planner, and I've worked as a financial advisor for Morgan Stanley and Etrade. I eventually left to create Money with Maggie, where you can receive professional financial guidance regardless of your net worth. Take a look at my services in the link below, and let's get started. Think of your portfolio review as checking in with your employees if you were a manager. From this perspective, what's the point of a review? You want to make sure your employees are in alignment with the goals for your company, that they're making progress towards those goals, and that they're still cost effective. Translating this towards reviewing your portfolio, the same principles apply. The first step is to ask, are your investments in alignment with your goals? To know this, you have to understand what your portfolio goals are. If you're 10 years or more from retirement or from needing the money to pay your bills, you're likely in the accumulation phase of life and will be focused more on overall growth of your portfolio. If you're less than 10 years from needing the money, you're likely in the preservation phase, where you want to start focusing on reducing the risk and begin to protect what you've accumulated while still growing your assets overall. If you've entered retirement and now need to use your money, then you've entered the distribution phase. Here, you may want to seek a much more conservative approach and look for income-producing investments. Using your phase of life to guide you through step one, check first that your investments fall in line with the phase of life you're in. If you have really conservative investments but are far from needing the money, then you may want to make changes to get that money working appropriately for you. The opposite applies too. If you need the funds soon, make sure you're not invested too aggressively. This is especially important now, being at all-time highs in the market. This could cause you to lose a lot of money and not have time or income on your side to recover from your losses. So how do you go about checking this? Look at your statement or online and find your asset allocation. It'll be a pie chart that looks something like this. The further you are from retirement or needing the funds, the more aggressive you can be in theory. The closer you get to using the money, the more conservative your investments should become. Again, in theory, because we all have different capacities to take on risk. Step two is to ask, are your investments making progress towards your goals? Start by reviewing each investment within the category, and here's how.
Which portfolio you fall into, and we'll just use the moderate for example, then come here, click on details, and you want to see that your portfolio lines up something like this. So all the stocks should be broken down into different categories so that you can have exposure to different areas.
Once you know where your investment falls, you can review its performance against what is typical performance for that investment type. If you use index funds or an ETF that mirrors an index, this will be really quick and easy. All you do is plug your investment in from each category into Google and check against the index. Here's how.
Because it's an ETF that mirrors the S&P 500, and it's actually one we hold in our portfolio. Come down here and click More, and it will pull up this chart where you can then click this and compare to the actual S&P 500, and see it like drops down this menu to make it easy for you. You pull this up and you could change the time frame up here. What you really want to see is the lines move together in sync, which in this case they do. So this is perfect. When I bump this one out even further, it does show a big discrepancy, but I think that's because the ETF probably just was formed right here. So the S&P 500 index has already had a larger start. And so that's why you see that huge maximum. But on a regular time frame, you can just see that they move exactly in sync, which is perfect.
If you see that the fund or ETF is off from the index, then you want to dig a bit deeper to find out what's going on and potentially make changes. If you're using individual stocks within your portfolio, use tip ranks to give you an idea of what analysts expect from the company. And keep in mind, they aren't always right and they can be really wrong, but use this along with your own common sense. If you're still using the company on a regular basis and your friends and family are too, then it makes sense to keep holding as long as you don't see any red flags. Take a look at this video for help researching stocks. If you're using mutual funds, use the same example I shared earlier by plugging the fund into Google and compare it to the index. With mutual funds, aside from index funds, you typically pay a higher fee than index investing, so you want to make sure your performance is better than the index, otherwise the fee probably isn't worth it. Here's an example, and use your own fund for comparison.
Large cap growth fund, just to show you what I'm talking about. So with this, you want to do the same thing we talked about earlier, which is compare it to the index, because each fund you have should represent some sort of index or some slice of that pie that you had. So for this one, okay, the blue is the American funds and the yellow is the S&P 500. What we want to see is if the fund is actually performing better than the S&P 500. We can see over a 5-year time frame, the American funds does not do as well as the S&P 500, but if you scroll down, you can see you're paying 0.64% per year on this fund. And if it's not performing better, then it doesn't make sense to pay that extra fee, because you can do an index fund for much cheaper.
Step 3 is to review the help you receive. If you're paying any management fees to a financial advisor, ask yourself if they're still offering value for the fee you pay. They should be reviewing your portfolio on an annual basis and communicating that with you. Sometimes advisors do this at the beginning of a relationship with you and then forget about you over the years. I'm guessing you don't have an advisor if you're watching this and reviewing your own portfolio, but still wanted to give you a note on that. Another thing about fees I want to mention is don't obsess about paying the lowest fee possible. Keeping fees low overall allows you to keep more of your money, but if you're so concerned with fees that you don't even invest, then you're missing the entire point. You want the fee you pay to be worth the service it provides. A good example of this is what we just covered with the mutual fund. In that case, you pay more for worse performance. If you're paying more for a fund, then you want the performance to be better than the fund. If you'd like a second opinion on your investment strategy or just need some help getting started, I do offer individual financial guidance sessions as mentioned earlier, so take a look through the link below at my services if that sounds like something you could benefit from. Thanks so much for watching. Remember to subscribe if you're new here, and I'll see you next week. Bye!